Hello and welcome to the lecture for part 1 of chapter 12. So this chapter deals with partnerships. So up until this point in Accounting 201 and in the first chapter in Accounting 202, we've been dealing with proprietorships, and I'll explain a little bit more from a legal standpoint what that is. So this chapter gets into partnerships, so there's more than one owner, and that gets a little bit more complicated. Next chapter we'll talk about corporations, which is again another level of complication. So in this first part I'm going to just give an overview of proprietorships, partnerships, and LLCs. We'll talk about how we form partnerships and divide net income, and then I'll talk about admitting new partners. In the second part of the lecture for this chapter, I'll talk about what happens when partners withdraw, what happens when we liquidate a partnership, when we end the partnership, and then I'll go over the statement of partnership equity for you. So a sole proprietorship is a company owned by a single person. If you're going out and mowing people's lawns for money, you're a proprietorship. I do consulting for people from time to time on accounting matters. I operate as a sole proprietorship in that sense. So it's very simple to form. A lot of times you don't even need to do anything legally to do that. You just start engaging in business unless your particular business requires special licenses, like being a manicurist or a real estate agent or something like that. The big downfall of a proprietorship is there's no limitation on legal liability. So there's no distinction between your company assets and your personal assets. So say as an example, you're working on cars on the weekend in your garage for people and you charge them money for that. You forget to reconnect somebody's brake lines, they leave and crash their car. They can come back to you and sue you and legitimately collect money from you, but that money isn't just specifically limited to what your business has. It's your home, your retirement savings, whatever, your vacation property, whatever else you have can be sought in that lawsuit. So that's the key downside to a sole proprietorship. It is not taxable unto itself. It is included on the owner's personal tax return. It has a limited life, so you can't pass a sole proprietorship down to your children. It ends when you end. And because of that, it has a limited ability to raise capital. So if you need to invest in machinery or do something to expand your business, your only option is for you as an individual to put more money into that endeavor. Partnership is an association of two or more people that own and manage a business for profit. And it can happen legally where you sit down and draw up papers, or it can happen just by default. If you start engaging in business with other people, you are a de facto partnership, whether you've declared yourself as such or not. So it's a little more complex to form. I can't stress the importance enough of having a detailed partnership agreement. And oftentimes it's a good idea to involve a lawyer in that so that you don't miss something. That partnership agreement is going to cover all of kind of the rules associated with your partnership. So who is contributing what to the partnership? What about further contributions to the partnership? What about withdrawals from the partnership, taking money out or taking assets out of the partnership? What about admitting new partners? What about when a partner leaves? How are we going to break up when this ends and split up the assets? All of who's going to contribute what in terms of work. So all of those things should be agreed upon in advance and written down so that there's less likelihood for there to be misunderstandings and arguments later. The big downside to partnerships is they also have no limitation on legal liability, and it's joint and several liability, which means that each individual partner is personally responsible for the entire debt of the partnership. So say I go into a partnership to work on cars with two other mechanics, and together we have a 3-person partnership, and we forget to connect somebody's brake lines and they crash into a bunch of cars and cause a bunch of damage. They could sue us if my other two partners have no personal assets. Maybe they're personally bankrupt. I, as the third partner, would have to pay the entire amount. And then it's up to me to go after the other two people. So that's a big downside. You have to be very, very careful if anybody asks you to join a partnership. It is not taxable like sole proprietorships, so a partnership files an informational return with the IRS that tells them this is how much money we made and this is how it was allocated to the partners. Each of the partners gets a K1 that says this is how much of the income you should report in your personal tax return, and each partner pays their own tax. It has a limited life unless provided for otherwise in the partnership agreement. The partnership ends when either somebody leaves or somebody joins and a new partnership starts. They have a limited ability to raise capital. It's really only through bringing on new partners that they can raise money. All partnership property is co-owned, so if you contribute some computer equipment or machinery or a vehicle to the partnership, that becomes partnership property. You can't just take it and go home if you don't want to be there anymore. Mutual agency, that means that all partners can obligate the partnership. So another partner could sign a lease and now the partnership is committed to that lease. The one benefit is that they can participate in income, and oftentimes a partnership, if you're careful about how you choose your partners, the whole can be greater than the sum of the parts. You can have synergy there. Limited liability companies are kind of the best of both worlds, so they're very popular. So it also provides the same kind of form as a partnership in terms of not being taxable unto itself, but it provides for limited legal liabilities. So each member, they're called members, not partners, each member's personal liability is limited to their investment in the LLC, so their personal assets aren't at risk. So that's one benefit of an LLC. So when we form a partnership, we record the assets that come into the partnership that are being contributed at their agreed upon value, not necessarily the book value that they were listed at in the previous business's balance sheet or something like that. They come in at whatever the negotiated fair market value is. So we put those assets on the book, we put the liabilities on the book if the partnership assumes liabilities of the partner, and then the net balance is going to be a credit to that particular owner's capital account. So in a sole proprietorship, we had one capital account, and partnerships will have a capital account for each partner. So dividing income can be done in a variety of different ways, and it should be documented in the partnership agreement. Here's how we're going to split up income. If there's no language in the partnership agreement about dividing income, then it's divided equally by default. So in this case here, they've decided to give a salary allowance. And again, partners aren't paid a salary. They are owners of the company, so they can accrue capital and withdraw money. That's how they pay themselves. But in this case here, we recognize there's two partners, Stone and Mills, and maybe Stone is working more hours or brings more experience to the table or whatever the case is, but we decided, or the partners agreed, that Stone would get a higher salary allowance than Mills. So in this case, they had net income of $150,000. So the first allocation was that salary allowance of 60 and 48, and then their agreement is to split the remainder equally. So they have remaining 42,000 of income. That's 21,000 to each partner. And it could be done in a different ratio or something like that. When you see something like a 2-to-1 ratio, that means there are 3 equal parts. So we would take 42,000, divide by 3. One partner will get 2 parts, one partner will get 1 part. So whenever there's a ratio listed, you add the two numbers together. That's how many parts you're doing. In this case here, they also had an element for interest on the initial investment. So this is often used when maybe one partner puts a lot of money into the partnership and the other partners put a lot of labor into the partnership. You may have a provision for the partner that put in a lot of money to earn interest on what they put in. So in that case, we'll have one allocation for salary, another allocation for interest, and then the remaining income is going to be split evenly in this case. So we need to do this kind of work so that we can, when we close out our revenue and expense accounts as part of our closing process, we know which capital accounts to touch for the difference for the net income. So admitting a new partner to the partnership can be done 2 different ways. One, a partner could purchase an interest from another partner. So the cash doesn't ever enter the partnership. It's a transaction between 2 individuals. One partner is leaving and a new partner is coming in, or some portion thereof. So there's no change in partnership assets in that case. So it's just an exchange between those two partners. The other would be contributing assets to the partnership and bringing new assets in. In either case, the first thing we need to do before that takes place is readjust the market values of assets and, if necessary, the market value of liabilities, which doesn't happen very often, and we accrue those to the partners. So before a new partner comes in, we make adjustments. Maybe assets have become worth more money, like a building was increased in value because of the market conditions or whatever, but we want those benefits or damages to accrue to the existing partners before the next partner comes into the mix. So if we purchase an interest from an existing partner, that's outside the partnership, so no cash enters or leaves the partnership. So we debit the capital accounts for the portion of the interest that the existing owners are giving up, and we credit the new partner for what they have. So it's just allocating money from one partner's capital account to another partner's capital account to recognize that transaction. Now, if the partner is admitted by contributing assets to the partnership, then we're going to, like I mentioned, revalue the assets and adjust capital accounts. And then the value of the contribution by the new partner is compared to their stake in the new asset total after that revaluation is done. So if the value of the contribution equals the stake, so if after they contribute the, let's say as an example, the new partnership has $80,000 in net assets, and Joe, in this case, Joe Cantor, is getting a 25% stake in the business, then the $20,000 that he's contributing equals the 25% of the new asset total. 25% of 80,000 is 20,000. So we simply record cash and record the new owner's capital account. There could be a situation, however, where the interest that they get is greater than the cash they put in. That could happen if we're trying to, that could happen if we're trying to entice somebody to come into our partnership because they bring some special skills or customers with them or something like that. We may give them a larger stake in the new business than what their contribution would reflect. So that's the case here. A contribution is greater than their stake in the new asset total. So the other partners have received a bonus. And I just said that backwards. I apologize. So in this case, the money that they're putting in is greater than the stake that they're receiving. So the existing partners are getting a bonus and they have their capital accounts adjusted. So in this case here, we have two different existing partners that have capital balances of 20,000 and 24. And then Diaz, a new partner, contributes 31,000. So after that contribution, the total equity will be 75,000. And in return for that, Diaz is getting a 1/3 interest in the partnership, which is worth $25,000. So this new partner is contributing 31,000, but getting an interest that's worth 25. So the new partner is paying a premium for their interest in the partnership. So maybe this is a really growing business that they want to get involved in, so they're willing to pay more than what they're getting. In that case, there's a bonus of 6,000, right? The difference between 31 and 25 is going to accrue to the two existing owners. It's kind of their increase in capital relative to the value of their business increasing. So in this case, 31,000 cash comes into the partnership. We recognize Alex Diaz as having a 25,000 or 1/3 interest, and then we increase the capital accounts of the two existing partners. Now the opposite could happen when the value of the contribution is less than their stake in the new asset total. That's where the new partner receives a bonus. This is where we're giving somebody a good deal because we're enticing them to come on board. So in this case here, we have two existing owners that have capital balances of 80,000 and 40,000, and a new partner contributes $30,000 in return for a 1/4 or 25% interest in the business. So after the new partner's contribution, they have 150,000 in total equity. 25% of that is 37,500. So in that case, the new partner, Ellen Chow, is receiving an interest of $37,500 in return for putting $30,000 in. So maybe Ellen has some special skills that this partnership really feels they need. So this new partner gets a bonus of $7,500. So the way we record that entry is cash will increase by 30. The existing owners, their interest is reduced, and it appears that in this case it's reduced in proportion to their capital balances. So Janice's goes down by 5,000, Steve's goes down by 2,500, and Ellen gets the 37,500 in her capital account. So in this case here, the bonus is being taken from the existing partners. So that's the end of the first lecture for Chapter 12. I look forward to talking to you in Part 2. Thank you.